Hi students, this is Mr. Jason. So we have been covering 4 different categories of ratios so far. We have covered liquidity, stability, profitability, and market ratios. So the final category of ratio we will cover would be efficiency ratios, and there are 2 ratios in this category. So basically, efficiency ratio measures the performance of the management of a company in the areas of inventory and accounts receivable. For accounts receivable, we will look at debtors collection period ratio. For inventory, we'll look at the inventory turnover ratio. So let's look at the debtors collection period ratio. This is in page 285 of the textbook, by the way. So the debtors collection period ratio measures how quickly a business collects money from credit sales. You need to look at credit sales because it is only when you have credit sales that you have debtors. Now, when we calculate debtors, we need to use the gross debtors amount, so do not minus allowance for doubtful debt in any calculations of debtors for debtors collection period. The formula for this ratio is average debtors divided by net credit sales. So times with 365. Why times with 365? This is because the answer is in days. Let's look at an example here. So when we look at average debtors, it is just like how we calculate the average assets in the rate of return on assets. So you look at the accounts receivable or debtors at the start of the year. This is actually the end of the previous year, which would be the same as the start of the year. This is the ending accounts receivable or debtor for that year. So you just add the 2 and then divide by 2. That would be your average debtors. Net credit sales would be this. So the answer here, once you multiply it by 365, is 39 days. This means, on average, Wesco Limited is taking 39 days to collect money owing from credit sales. So they would need 39 days to collect back money. Now, do you want this ratio to be higher or lower? The answer is you do want it to be lower because a higher ratio means that you are taking longer to collect the money owing, and that's not very efficient, is it? So let's look at an interpretation. If you have a higher debtor collection period, it is not very good. It may be due to poor debt collection procedures. Maybe they're not quickly following up on the overdue accounts. They're taking time, they're delaying, and that's why. Or sometimes there's a delay in sales invoice processing. Sometimes it may be due to the failure to check the credit rating of new customers, because sometimes customers who are new, they may not pay you back because you don't know them very well. So if you don't check their credit rating, if you don't check their credit histories, how good were they as paymasters previously, then you might face this problem. A business may also offer longer credit terms. So let's say for 39 days answer, if the business is offering like a 60-day credit term, then that's actually okay because 39 days is within 60-day period. But if let's say the credit term is 30 days, then 39 days is not good, right? If it is a decrease in the ratio, then all this reverse is true. Let's look at inventory turnover. For inventory turnover, it measures how many times each year a business replaces its inventory. So how many times in a year you have to restock your inventory on the shelves. So it is cost of sales divided by average inventory. Now all these formula are given in your specifications booklet, so do not worry about you need to memorize formula for ratios. The average inventory, the way you calculate it is the same. So opening plus closing divided by 2. Now, when you are required to calculate the inventory turnover for this example, then you would need to average the inventory out. So the answer is 20,000. And then you take the cost of sales divided by 20,000. You get about 4.5 times a year. So this means that the company is replacing its inventory 4.5 times every year. How do I get this once every 2.6 months is, if you want to convert inventory turnover ratio into months rather than times, then you can take 12, which represents 12 months, divided by 4.5 times. You get once every 2.6 months. But most of the time, questions would only require you to calculate inventory turnover in times. You should compare this to the industry average or to previous year's inventory turnover ratios. Do you want this to be higher or lower? Definitely higher, right? When your inventory turnover ratio is increasing or higher, that means your products are popular. That's why they're selling fast. If it is a decrease or a decreasing ratio, then there might be inefficiency in inventory management. Maybe there's slow-moving inventory, there are obsolete inventory, which means that the inventory is not up to date, it might be outdated, or maybe the business has ordered too much. Yeah, so you need to cut down on that. But just remember this, for inventory turnover ratio, if it is too high, it might be a problem because there might be an out of stock issue where you are not able to replenish your inventory quickly. Yeah, so that might mean a loss in potential sales. Just imagine this, like a bakery. If let's say the baked goods are too popular, then they sell off too fast, and customers who are still waiting for the new stock need to wait because you need time to replenish your stocks, and you might lose them because they might not wait too long.